What a week it has been since we last released a podcast. Feels like we pretty much went through like two whole cycles in the past week. We got that lower vamp touch that we were talking about last week. This is playing out exactly how we were talking about it. Like, we're probably going to get a lower vamp touch, get a reset, and head higher. And that's exactly what happened. And I'm glad it turned out this way. Obviously, it's risk on, and this is kind of what you'd expect from a risk on dip. This is what happens. This was a risk on dip, which is very buyable. And we now broke the longest, I think it was the longest streak in history without closing below mid vamp. So now we finally ended that streak, which is good. I think this is a very bullish thing that we're seeing right now. We got that reset, recalibration, got out, all the weak hands sold out, and now we have some more fuel to the fire to be able to break out. And actually today was a very bullish day. Like, we were selling off for most of the day, but we never even dipped to mid vamp, and then an insane ramp into the close, which is a very bullish sign.
Yeah, so not every time when you get these bull market dips do they play out this way in particular, right? Like last week we were very vocal about the risks of, just some sort of exhaustion in the rally that we've been seeing. And not typically you don't get the drop to lower vamp and then the push to upper vamp literally within the week, right? So this is like a primo setup here where you have the washout and the recovery. And as long as you're over mid vamp, the base case is going to be new all-time highs. That's just the base case. And matter of fact, not only is NASDAQ now back above mid vamp, but as we're recording this, Bitcoin is over mid vamp as well. So this is also giving that confirmatory indication that, look, Bitcoin now is shifting back into a base case being new highs environment. And as long as Bitcoin can hold mid vamp, which is about 116.5 right now, as long as Bitcoin can hold that, the base case is going to be new all-time highs.
Yeah, it's looking good. It's looking really good. And we're seeing Trump coming out with these tariffs on semis as well, and it's it's kind of ridiculous. It's like a tariff, but everything's exempt. So, like,
yeah.
That was actually a bullish. The market took that as bullish because that was some uncertainty around how that was going to play out, and now that uncertainty is off the table. As long as these companies are making an effort, in terms of Apple at least, in tech, right. Like Apple making an effort to start manufacturing in America, which I think they said they're going to manufacture iPhone screens in America. So there's that uncertainty is off the table. And then you have the semis where Nvidia's exempt from it. Intel is exempt from it. Who else is exempt? Pretty much everyone's exempt. All the big names are exempt. So that uncertainty is off the table now. So I think that just opens the door for new all-time highs.
Yeah, and you can really see what's going on here with like the headlines and the market reactions that tariffs are now, theoretically, tariffs are not irrelevant in the grand scheme of macroeconomics, right? A new tariff is it has a price impact and a supply and demand impact, et cetera, depending on where the tariff is and where the goods are going and coming from. But you can see that as of late, the market's kind of been shrugging off all these tariff risks and essentially giving you the indication that the market's not too concerned about the way tariffs are being implemented. And I think for the most part, you're kind of seeing like add-on tariffs now, right? Like the sectorial, the additional country specifics, depending on how the trade deal negotiations are going, etc. You're not really seeing that broad blanket that you saw last spring here in April, where the market really took a nosedive. And I know this is such a very simple and basic approach, but it really does seem like that was the environment where the market really took tariffs to heart and priced in the worst possible outcome. And the way markets work, right? They're very emotional, one-sided, right? So as they go to extremes on either side, so as we price in the extreme negative situation of tariffs and they didn't come to fruition, I think you essentially shook out a lot of the macro sensitive hands that may have had enough of the risk appetite. Maybe they were shaken out. Maybe they just through uncertainty, through foreign capital coming back home, and all things like that. And therefore, you've essentially shaken out a lot of the weak hands, and now you're in a position where a lot of people that were going to sell on tariffs and make that tariff bet that they don't want to be long equities, they essentially did that, and they were forced to buy back in on the way up. So the idea that a new tariff is going to spark another Liberation Day panic sell-off, they'd have to be extreme, and they'd have to come in at such a high, in high velocity, right, or in high quantity across multiple different countries at such an unknown rate. Basically, a surprise Liberation Day 2.0 for the market really to get shook. Now, this doesn't mean that tariffs don't play a drag on, or don't act as a drag on growth, because they obviously do, but the market's kind of looking past that. Again, there's a lot of walkbacks. There's a lot of exemptions. So if you're selling stocks because of tariffs, I think the move was when our system picked this up in early Q1 or late Q4 last year, with uncertainty risk being priced into the market and just a lot of risk off probabilities accelerating. That was the time to prepare for a tariff panic event or a recession or whatever you want to call it, a mini bear market. That is not now. That time is not now. Now we are in a risk-on regime, and as long as we maintain that regime, it's very hard for these, inconsequential headlines, which likely will be walked back or reneged or renegotiated, to really tank the market after what we saw earlier this year.
Yeah, it really doesn't seem like there's anything that's going to blindside the market at the moment. And Bitcoin's telling us that as well. Like, Bitcoin, the Nasdaq, but we did see utilities. We have seen utilities rising as well with the market. Of course, utilities does have all of these headlines pushing them up as well, with the factories and for AI and all this stuff, and the government subsidies that are going to likely be given to these utility companies. But it is telling me, at least, that there is some sort of safety that people are looking for still. And I think if you are someone that is worried that, okay, the market's like too high, we've been running for too long, it's time to hedge some risk here, I think utilities is a great play to hedge some risk.
You're probably not wrong there, because already we've seen that utilities have kind of leaped up without bonds, right? Because the idea here is typically utilities are an interest rate sensitive sector. Rates need to, or yields need to fall for utilities to really outperform. And you look at TLT. TLT is not really any higher than it was going back to February of this year, and then November of last year, or any lower. Any higher. I'm sorry. So, and we are actually lower than all the prior pops. So rates are still off lows, right? So rates aren't like really breaking down. And therefore, like, you look at utilities and they're just on a full-fledged breakout, right? Like, they really are. Then you have to say to yourself, like, there's more here than just interest rates, right? There's more to this scenario than just rates. So we've been saying that, since we started mentioning utilities a couple of months ago, but ultimately utilities do act as a good slowdown hedge if they're bullish trend. We're not seeing a slowdown at the moment, but as Artie, you're saying, look, if you want to position yourself for that out of, just abundance of caution, then utilities probably aren't a bad play as long as the trend holds bullish.
Yeah, like, you would still capture the upside of the general market.
For sure.
And actually lately it's been outperforming the market. So it depends how it goes from here. Obviously, historically it underperforms during bull markets, but it still moves higher. So I think that's a way better hedge than trying to get some puts and burning capital on that.
That's true. You will get paid to hold this via this sector style dividends, and you have that slowdown upside risk. So there's a nice little slowdown hedge baked into this play. We are obviously not long utilities anymore. We are positioned risk on. We are in a risk on regime, but I think it's important to mention some things or some items to watch out for that would possibly lift us or push us out of a risk off on regime and into a risk off regime. So what are you looking at here to see really, signals that we might be leaving risk on?
Uh, I think inflation is what we need to watch out for, because that's really what's going to fuck things up if inflation continues to rise and starts becoming problematic again. That's where we're going to start seeing issues where the market starts pricing cuts out of the curve, and even possibly pricing in a hike if it's really bad. But we're nowhere near that at the moment. But if inflation does continue to rise and starts becoming an issue, I think that's really what's going to stop this bull market here.
I agree with you there. I mean, like the Fed has been so overly cautious that if like inflation does really start to unanchor, I think we are, instead of this hawkish hawkish style pause where the Fed is essentially just being hawkish by not cutting rates, right? Which would some would call neutral, but their policy has been net hawkish. I mean, they've had some dovish fluff, but they're overall obviously they've paused the cutting cycle. They're on standby, so it's been net hawkish, right? You can even say neutral, but some depending on who and what you're listening to. Ultimately, here, the terminal rates are not at cycle lows, which basically what this is it's the market indication of where the Fed is going to bottom their policy during the cutting cycle. We are right now around, I'd say 3% in that ballpark. Last summer when the panic hit, right, when the labor market slowdown really accelerated, this went down to about 2.75 or 2.75%. So we still have over a rate cut to go to be priced into the entire curve to get us back to where we were last summer at the lows. So the market is net more hawkish than it was around this time last year, roughly, right? Or at the lows. And what we saw happen last week, interestingly enough, with the NFP, with those large negative historical revisions, I'm pretty sure that obviously that's what nuked the market here for a couple of days. And, you kind of have to look past that. You can't get too caught up with one labor print, even though, the labor print came in around 70,000 jobs added in July. And that there's a high chance that likely based on the prior revision history, that will be a negative number in August. So like when we get the August report in September, there's a good shot that July gets revised down. Right now, the thing here is if I'm thinking this, the market's thinking this, everyone kind of understands this, that kind of gets priced in, or that does get priced in rather quickly. So the ultimate goal here then is to look beyond those NFP prints, because the issue with the payrolls is due to a constraint in immigration, you essentially can lower the monthly payrolls added that are required to keep the economy in balance. So like hypothetically, let's just say the break-even payroll rate is 100,000. When you cut immigration, the way that the way that they are doing it in America, and the administration is clamping down on the illegal members in the workforce, what ends up happening is that number can fall to say 50,000 without actually destroying the unemployment rate. So you have a net visually slower growing economy, but under the surface, the economy still isn't falling apart. So that's where this interesting dynamic is happening, because you see the ADP report for July showed 100,000 added jobs. So there's obviously a discrepancy here of what's going on, and then you're seeing jobless claims, and we can even whip those out real quick here, right? So let's look at jobless claims on a seasonality basis. For the last 10 years, excluding the pandemic, like we are currently pretty tight in terms of historical seasonality. Like we've seen much worse here. And it's one of those things that's like, if jobless claims really aren't, turbo boosting to the upside and just ripping, and they're kind of running at seasonality lows, or at least close to there, it's hard to make the case that the labor market's imploding. So I think that what happened was you had that initial overreaction on Thursday into Friday, right? Thursday was the Thursday morning or overnight Wednesday was the Meta earnings and then Microsoft earnings. We sold that gap, NFP gap down, sold all the way down to lower vamp, and since then we pretty much retraced um, most of that post Meta earning gap down and or sell off event, and it looks like at this point we might be headed for all-time highs here as early as Friday or early next week.
Yeah, which is pretty sweet. Like this is risk on. This is why we've always said like risk on is our favorite regime. It's just everything's in your favor. The market's got momentum. Good news tends to come out during risk on regimes, and we just ride the wave until the music stops. And I think the system's going to tell us when the music stops ahead of time, which that's the beauty of our system.
Absolutely. Our system's been outside of, a couple of choppy trades this year, with bonds being one of them. In risk terms, our system's been spot on at pivoting out of, risk when it needed to earlier this year, basically avoiding the entire Liberation Day equity market implosion. So I think that having a system is actually very important in regimes like this, because let's go back to what you just said about good news and bad news, right? And good news happening in risk on and bad news happening in risk off. And I don't think it's necessarily the news being labeled as good or the news being labeled as bad. A lot of people like to look at news and say, oh, is good news, and is bad news, bad news. In reality, what's happening is if the market's in a risk-on environment or in a risk-on regime and you're in a bullish environment, when headlines come out, even if they're bearish, like this NFP report, the market can look past it, even if it's initially weak, and that bad news somehow gets transformed into good news. And what that basically is telling you is that news releases are being there's an inherent bias behind these news releases to find the more optimistic data points or the optimistic narrative with these data points. If the market's in free fall and this jobs report were to come out and the market would sell off even further, that would give you the implication that the market is just really looking for reasons to continue the bear market sell off or the risk off environment. So in a risk on environment like this, a lot of news that will come out that you may say, well, 3 months ago, these tariff headlines would have sent us down another 5%.
Yeah.
But they're not.
Yeah, now the market just looks past it.
Yeah, so that's the most important thing in this regime. And understanding the regime is what gives you the edge to kind of shrug off nonsense and essentially mute a lot of noise. And that's why the system is so important, because we can log in, literally check where we are in the regime map and figure out, look, okay, we're in risk on. There are inflationary risks in the market, but growth is positive. So there's a risk that the Fed won't be able to cut as much as maybe some optimists would be looking for. But on the other hand, if growth is positive, then you actually have cuts coming off the table for bullish reasons. The Fed's not reducing rates because the economy is actually running too hot. So that's why this is important. Now, if the economy was very weak and the Fed was playing the hawk game, what ends up happening then is you essentially have the Fed adding gasoline to an already existing fire. So that's why the regimes are so important. In a risk-on regime, the tariffs likely have been and will continue to be irrelevant for the time being until we go to risk-off, and rate cuts are likely to be irrelevant. And people will harp on them. They'll harp on, when the next Fed cut's going to be, when the next tariff deal is going to be, but those are, quite frankly, all irrelevant. The most important thing right now is to stay locked into your positions and monitor the regime and monitor the trend. As long as NASDAQ is above mid-vamp, you have very low chop risk. This is what happens when you're above mid-vamp. You kind of just drift up. So as long as we're above mid-vamp, base case is new all-time highs, higher equity markets, bullish markets. And as long as the trend's bullish altogether, right, we have quite a drop here to even flip the trend. So there's a lot of room here for consolidation if you wanted to do a small little pullback like we saw earlier this week. These are the things that need to stay. So we need to have the equity market, NASDAQ in a bullish trend and above mid-vamp. That's 100% risk on confidence right there. And the system being in risk on itself. And as long as those things align, stay locked in. That's how we're going to win. That's what we are going to do, and that's what we have been doing.
Yeah, like literally the hardest part of this regime is being able to ignore the noise and not falling for any of the bear noise. That's all it is. Like there's so many
Friday,
people
man.
out there that, yeah, exactly. Like there's so many people out there like, oh, it's over. There's the tariffs. There's all this happening. There's so much bad news. Like we're up so much. At the end of the day, we're really only up like what 4% since the last highs earlier this year.
Oh yeah.
So
I mean,
so that
we can
that
just map it
argument
out real quick.
is out the window too. Yeah, 5.7%. So
yeah,
over the span of 7 months, like it's not that crazy. So yeah, just ignore the noise, touch some grass, turn your computer off, and wait for the music to stop. The system's gonna tell us. That's really the hardest part.
And in this environment that we're in, this is where this type of regime, when you're in a risk-on regime and Bitcoin is above mid-vamp, God candles are likely. That's just what happens. And could we be seeing the start of a formation of one right now? Possible, but ultimately, God candles happen like when you are above mid-vamp and you're just legging up. That's when you get the 4 or 5% at these price point candles in Bitcoin, and that really tends to happen. When you're blasting through all-time highs in a risk-on environment, people are piling in late leveraged shorts that got liquidated, or late leveraged longs that got liquidated on the dip are rebuying, and shorts are getting blown out. This is what's going on in risk-on regimes. So you have to stay vigilant here. Don't let, the NFP dip earlier this week, that shook out a lot of people. A lot of people decided to, just because there was one weak labor print, to dump their equity longs. And look, could we see more labor market weakness develop? Absolutely. But likely our system is going to already be rolling over or even pivoting before the major crap hits the fan. So if we can leave you with one thing this week after what we just went through, and if you survived the little snapback of the summer of 2025 in the equity markets,
the bear market of August
2025, stay locked in. Be careful out there. You're going to have more of these dips. These are healthy dips. They strengthen the trend. What ended up happening here is you rotated a lot of late leveraged longs out. You put shorts on that are going to get rotated out and squeezed out into an equity market reversion into all-time highs. And at some point, the cycle will repeat itself, and you may even get a more consistent or firmer dip down, pushing into the lower vamp. We haven't seen that yet. That's possible. That likely will happen within a bull trend, and those should all be expected. If you can't handle price rotations between upper and lower vamp, you're way too over-leveraged. Way too over-leveraged, and you're not going to make it through a bull cycle. You're just going to get smoked. So keep your leverage at a comfortable level where you can drift between upper and lower vamp with ease. Keep your mindset fixed on the regime that you're in, the trends that you're in, the reason why you're holding the assets you're holding, and why you are positioned the way you are, and let the market take you to your destination. And don't really freak out about the blips, the 2% blips up and down, and tariff headlines here, Fed appointments here. We're going to have a chair appointment coming up, right? These are all things that are going to, or at least the indication of an appointment. These are all things that are going to likely move, if it's bond markets, equity markets, short term with a quick little dip or a little rip, etc. Don't pay too much attention to those. The macro regime, the system, encompasses the entire regime, the entire macro environment, not just the stirs market, or not just the labor prints, right? It's all bundled together to give you a clean cut, risk defined output of where you are in the market at the moment. And as long as that's risk on, you are not going to shake us out of the longs. That's what's going to happen. We're going to sit here and we'll say the same thing every week until something changes. Thank you so much, guys, for listening. If you have any questions, feel free to reach out to us on X at The Market Radar, or go to our website at market-radar.com.